This is the Ugland House, the modest 5-story building located somewhere in the Cayman Islands. And in 2020, around 20,000 companies had a registered office there. Now, like Bernie Sanders tweeted, that's either one very crowded building or a phony address used for one purpose: to avoid paying taxes. US President Barack Obama called it the biggest tax scam in the world. This is just one of the many, many ways the rich use offshore accounts to stay invisible. Welcome to offshore banking. Now, the world's wealthiest people, from celebrities, politicians, and CEOs, all use offshore systems as a normal part of their financial planning. Places like the Cayman Islands, Switzerland, and the British Virgin Islands have financial systems designed for privacy, flexibility, and tax efficiency, and they actively compete to attract wealthy clients from around the world. It's insanely profitable without needing to produce anything. Unlike countries that rely on exports or tourism, these places have turned banking, secrecy, and favorable tax laws into an entire industry. Experts estimate that over $10 trillion is currently held in offshore financial centers around the world. That's more than the GDP of Japan, sitting quietly in jurisdictions most people couldn't even point to on a map. A report from the Organization for Economic Cooperation and Development shows that this offshore system accounts for an estimated 8 to 10% of the world's total household financial wealth. Over $800 billion of that wealth sits in Swiss banks, hundreds of billions more in Hong Kong, Singapore, Luxembourg, and the Caribbean. But, what is offshore banking, really? Well, at its core, offshore banking just means putting your money in a country where the financial rules are different and more favorable for you. These countries are called offshore financial centers. They offer a mix of 3 things that make them irresistible to the wealthy. Things like low or zero taxes. Some have no income tax, no capital gains tax, or no corporate tax at all. They've got privacy laws. Your name doesn't show up on public records, and in many cases, not even on internal banking documents. And loose reporting systems. You don't have to explain every dollar the way you would in, say, the US or the UK. If you're rich enough to matter, these countries want you as a client. Now, before we walk you through how it all works, you need to first understand one very crucial distinction. The rich don't own anything. Their companies do. This is what makes everything possible, okay? And this is the difference between traditional banking and offshore banking. Because if you're a salaried employee, your income is reported before it even hits your account. Every paycheck is taxed, every bonus is tracked, every bank transfer above $10,000 is flagged and reported. Under laws like the Bank Secrecy Act, or BSA, and FATCA in the US, you must report foreign bank accounts over $10,000, declare foreign-held assets on annual tax filings, and disclose sources of income in detail. You miss a form and you could be fined, audited, or even charged. Everything about your money is visible by default to the government, to the bank, and sometimes even to third-party services. But let's do an example, all right? Let's say we've got 2 fictional millionaires. James lives in New York and earns $1 million a year as a salaried CEO. And Mike, who earns $1 million through a trust registered in the Cayman Islands and paid via a foreign holding company. So here's how this plays out. James gets a paycheck. His employer reports it to the IRS, withholds taxes, and pays him what's left. He lives in a high-tax state, so he's losing nearly half his income to taxes before he even sees it. Mike, on the other hand, doesn't technically earn a salary. He set up a trust in the Cayman Islands that owns a holding company in Luxembourg, which owns licensing rights to the software he developed. When money comes in, it flows through these entities, and Mike receives payments as distributions or dividends routed through countries with favorable tax treaties or no income taxes at all. Technically, Mike owns nothing. He decides when and how he gets paid. And this is where people confuse tax avoidance with tax evasion. Tax evasion is when you illegally avoid paying the taxes you owe, like getting paid in cash and not reporting it. That's a crime. Tax avoidance, on the other hand, is perfectly legal. It's when you use the rules to reduce what you owe, like writing off a business dinner or claiming depreciation on your car. Now, what happens when the smartest lawyers and bankers in the world make tax avoidance their full-time profession? Well, you get offshore banking, my friend. A system designed to follow the letter of the law while sidestepping most of the tax bill. Which brings us to one of the most famous examples of tax avoidance in modern history. This company bent the rules so far, it caught the attention of the entire European Union. But before we dive into that crazy story, we just want to take a moment to let you know that inside the Alux app, we've got more of this kind of insider knowledge that most people never access because they either don't know where to find it or they don't have the money to hire mentors themselves. You need people who've done the things that you want to do, guiding you towards your goals, and that is exactly why we built the Alux app. We find the most capable people in the world, pay them a fortune to coach our community, and you have access to it under a single subscription. And because it's digital, we can give it to you for cheaper than a gym membership. Go to Alux.com/app right now and download the Alux app and see why over 250,000 CEOs, entrepreneurs, managers, and creators are using it. The app is not cheap, okay? It's for professionals looking to break through using expert advice and coaching. But if you're early in your journey, we know how much every dollar counts. So if you download the app and scan this QR code, you'll get a 25% discount on your annual subscription. But let's get back to that crazy story I mentioned where the company bent the rules so far it caught the attention of the EU. We're talking about the Apple case. Now, Apple's offshore tax strategy is one of the most famous examples of legal tax avoidance in modern history. In the early 2000s, Apple set up subsidiaries in Ireland that technically owned the rights to sell Apple products outside the US. This allowed them to funnel profits from iPhones, iPads, and Macs sold across Europe, Asia, and Africa into low-tax entities, avoiding the standard corporate tax rates almost entirely. Thanks to a now-closed loophole in Irish law, Apple structured things so that these companies were stateless, not taxed in Ireland nor anywhere else. For a full decade, from 2003 to 2013, Apple rooted more than $120 billion through this setup. At one point, their effective tax rate dropped to just 0.005%. That's $50 in tax for every $1 million in profit. Instead of paying for the $40 billion they would have owed under US law, Apple paid just $600 million. And this right here is how it happened. Apple set up two special companies in Ireland. These weren't regular businesses with offices and employees. No, they were basically legal paper shells designed to collect profits. Then it gave those companies the rights to sell everywhere except the US. So now, when Apple sold an iPhone in France or Japan, the profits went to Irish Apple, not the US company. Now, normally a company has to pay taxes somewhere, usually based on where it's incorporated or where it's run from. But Apple found a loophole where these two things didn't line up, and that created a gray zone. So if you had a company incorporated in Ireland, but you didn't actually run it from Ireland, you wouldn't pay Irish taxes. Meanwhile, US tax law said we tax companies based on where they're incorporated. So if your company was incorporated outside of the US, it didn't automatically owe US taxes either, as long as the money stayed offshore. So Apple created companies that were incorporated in Ireland, so not taxed by the US, but managed from the US, so not taxed by Ireland. That means neither country taxed them. These subsidiaries became stateless entities. They legally existed, but no country claimed the right to tax their profits. Now, eventually, the European Union stepped in and said, hey, this seems kind of illegal, and they fought for over a decade until Apple lost in 2024 and it was ordered to pay $14 billion in back taxes. Now, many, if not most, of the world's largest corporations use some form of offshore banking to avoid taxes. Apple, Amazon, Google, Meta, Nike, Starbucks, and Microsoft have all been documented using complex offshore structures to minimize their tax bills. And according to the OECD, more than 40% of multinational corporate profits are shifted to low or no tax jurisdictions. According to the Panama Papers, over 140 public officials and billionaires used offshore shell companies to hold assets in secrecy. Then in 2021, the Pandora Papers revealed that over 35 world leaders, including presidents and royalty, were linked to hidden wealth through trusts, companies, and private foundations, most of which were perfectly legal. A study by the Tax Justice Network found that more than $10 trillion in assets are held offshore, and most of it is under the name of companies, not individuals. When most people get rich, they put their name on everything, but the rich, they take their name off everything. That mansion? Not in their name, it's owned by a company. That yacht? Well, it belongs to a holding firm registered in Bermuda. Even the bank account that funds their lifestyle? It's controlled by a trust or a foundation, not a person. If you don't own it, it can't be taxed, sued, or seized. And this is how it works, simplified. Step 1 is to create a company that exists only on paper. You start by setting up a shell company in the Cayman Islands, the British Virgin Islands, or some other tropical tax paradise. This company doesn't have an office, employees, or products. It might just live inside of a filing cabinet at a law firm. But on paper, it's real and it can legally own things. Step 2 is to let the company own the wealth. Now, instead of putting your name on the deed to your mansion, the company owns the mansion. Instead of opening a Swiss bank account in your name, the account belongs to the company. You don't own the yacht or the art collection or the intellectual property. The company does. So if someone comes after your assets for taxes, lawsuits, or political reasons, you shrug because technically you own nothing. Step 3 is to add a trust to seal the deal. And this is the final layer. The company that owns the wealth is then owned by a trust, based in an entirely different country. And the trust isn't in your name either. You are not the legal owner, you're just the beneficiary. You get to live in the house, sail the yacht, use the jet, but nothing is tied to you directly. That is how you end up with a $150 million super yacht owned by a company in the British Virgin Islands, held by a trust in Jersey, managed by a nominee director in Panama. But, okay, if your name isn't attached to your money, how do you actually spend it? Because the moment you transfer money from an offshore account to your personal one, especially in your home country, it becomes taxable. So you borrow against it. When Apple needed money to spend in the US, rather than pay taxes to repatriate its offshore profits, it borrowed against them. If you've got billions sitting in an offshore account, you can use those assets as collateral and take out a loan, often at ultra-low interest rates. This way you get access to cash without triggering a tax event. And then you borrow again and again and again and again until you die. It's an actual strategy. It's called buy, borrow, die. And you know, we might just talk about that next. Thanks for spending some time with us today, Alexa. We hope you found this valuable. We'll see you back here next time. Until then, take care.